All right, welcome everyone to still chuckling from that message from Steve. December 20th, story trading. Thank you everyone for joining. Tonight we got a presentation by Florian Buschek on DAVIDsTea, and then we'll run through the trade of the week. We had a big winner this week. Disclaimer. Story trading is not an investment advisor. Investing in securities involves significant risk of loss. We are recording today's presentation up until after the presentation by Florian. The trade of the week, we usually don't record that. So, and this will only be available to existing story trading subscribers within the WhatsApp groups. It's not going to be posted public or anything like that. Okay, everyone here should be familiar with what story trading is. I'll give a quick update again. This is a final week for people who want to invest in this phase. We're going to be raising money for, throughout our progress in the next couple of years. But right now we're raising money to launch our app into the Apple and Google stores, and we're trying to close that financing this week. So I'll talk about that real quick at the end. Okay, our intern is off this week. Did he make it? No. He's recovering from a voluntary procedure. He'll be okay. Everything's good, but it's going to take a couple weeks off. So we got the numbers updated over here. Average return is 38% now from the date of presentation. Man, if you analyze these numbers, it's amazing, right? So INTZ presented by Aaron's back on top there, 166%. And we got lots of names doing really well over here. It's going to be interesting to see how many will be over 100% after 12 months of these presentations.
I think last week we had 37% and it jumped to 38 for this week.
That's right.
And then even the names that are still in the negative, we're still positive on all those names and like looking forward to them in the future.
Yeah. This is just, we'll probably find a better way to visualize this in terms of what kind of moved. Maybe we'll find an arrow, up, down arrow ranking, something like that. But if you analyze this, you can see what it was that moved. So I'm not about to do that, but we'll make this presentation available as a PDF for those who want it. Just let us know. All right, with that, we're going to turn it over to Florian. I just unmuted you. Florian, do you need screen share?
I don't. Can you hear me?
Yeah, I hear you.
Okay. I don't have a presentation today. I'm just going to tell the story.
Okay, very good. Actually, so before you get started, then let me just,
You can pull up the chart. That's pretty good.
Yeah, that's what I'm gonna do. It's on the next slide there. All right, I'll just have that up there so people can have it for reference while you're talking. All right, you're good to go.
Right. So DAVIDsTea. I am talking my book here. I'm long the stock. I'm also long a couple call options, just to let you know. And then a little bit to the story. So DAVIDsTea is selling tea and accessories, extremely expensive ones, but they can pull that off because the brand is extremely popular. So if you look over social media, so for example, it's very popular and it's extremely, people love to boast that they are buying DAVIDsTea or gift DAVIDsTea for Christmas, for example. So there's no question the brand is very strong. And so that's basically the story about the business. They sell tea and a few tea accessories. So historically, they have done it in stores. These stores were not owned by them. They were basically all leased. Most of them in Canada and a few in the US. They had about 200 Canadian stores and 42 in the US. And the issue with stores is, if you think about retail in general, retail margins are very thin, but bigger retailers like Costco or Walmart, they make it up on volume. So they have very very tight supply chains, very high working capital and inventory turnovers. And so they can basically afford the stores and still make huge profits on thin margins. For DAVIDsTea, it was different. They had good margins, but if you think about tea stores, it's not like tea stores are always full. People just don't buy so much tea all the time that you can cover the fixed cost of these stores. And so the historical chart basically tells it all. Profits were not good, to the contrary. And the business just went downhill and downhill over many, many years. And so enter COVID, and now they finally had to make a big decision. And the decision was to get rid of all the leases and turn to an e-commerce and wholesale model. So the issue with leases is you can't just tell your landlords, okay, I'm going to stop paying my lease and you can have the building back. There's a certain liability. And because of these circumstances around COVID, they went into what is called CCAA. It's a Canadian thing. It's a sort of restructuring, and it's easily mistaken to be basically like bankruptcy, Chapter 11. When in fact, the CCAA is really only about rejecting the leases in this case, and the whole equity structure, the share structure is not touched at all. So it's not like in bankruptcy where the equity is wiped out and then the other securities get online, like unsecured, secured debt, etc. This is really only about the leases. Of course, the stock totally sold off on this news because nobody basically understands this until you look really closely what it actually means. And if we think about these leases, there are about 70 million now on the books. I will talk about that a little bit later in more detail. There's no financial debt at all. To the contrary, right now they have 20 million in cash and market cap is around 50 million, just for context. And so they've made this transition to close all the stores. They had to close them anyway because of COVID, and then they just let them close. So right now they will proceed with just a few main Canadian stores that were basically good from the beginning and to have them as sort of flagship stores. And everything else is e-commerce and wholesales, mostly e-commerce at the moment. In the last numbers, 84% were e-commerce and wholesales. The rest was in the remaining stores. What this means for margins is that gross margins are generally lower because you have to pay the transportation costs. So you would say that is bad. It is. On the other hand, you don't have to pay the leases, and you have many of the original employees are not there anymore because you don't have them to operate the stores. So salary costs and especially leases are going away. And so what that does to the operating structure is the gross margin is lower, but your costs below that line are also much lower. So overall, it's possible to get a profit. And we have seen this exactly in the preceding 2 quarters in Q2 and Q3. The issue with the current numbers is you need to really look very carefully because I would describe like the noise being higher than the signal because of this restructuring. So you will see astronomical numbers in operating income, EBITDA, and that's really because these huge liabilities are marked up and down depending on negotiations and expectations and whatever it is. And the real numbers of the underlying business are there, but it takes a little bit to actually see them. So if you think about EBITDA for the last 2 quarters and sort of the underlying business EBITDA, it was about 4.6 million. for these 2 quarters. Sales were down overall, but that shouldn't concern us that much because, of course, stores were closed and we are better off having profitable sales than unprofitable ones. And so it's about 4.6 million in EBITDA in these 2 quarters. But what is important to understand about the business is that these 2 quarters are seasonally very weak. The most important quarter is Q4, around Christmas. I said it already, Christmas present, and in winter, people like to drink more tea. What that means is in Q4, sales are typically, historically, 70 to 100% higher than in any other quarter. Q1 is also a much better quarter than Q2 and Q3. So the expectation, the reasonable expectation is that if we had 4.6 million EBITDA already in the 2 weak quarters, we will be much better off in Q4 and Q1. And if you estimate what that comes out to be, it's probably going to be for the full year about 50 million in EBITDA. That's a reasonable assumption. It's not impossible at all that we get much more to the tune of about 20 million EBITDA. Not at all. And we have anecdotal signs already that Q4 sales are extremely strong, that they have difficulties delivering, that they are running low on inventory, and things like that. So all indications are pointing towards a very strong Q4. And so if you remember, I said market cap is around 50 million, cash is 20 million, no financial debt. And now the big question is, so if you set that alone in relation to what I said, EBITDA of 15 to 20 million, it's extremely cheap. Now the big question, what about the restructuring and the lease liability? The nominal amount is about 70 million. So if we assume the worst case and say that they have to pay it all off, every single penny, then we are at about an enterprise value of 100 million. At 15 to 20 million EBITDA. That is the absolute worst case. And I would say that is probably cheap. It's not screaming cheap, but it's cheap. Certainly if you compare it to other e-commerce businesses and wholesale. But then the whole point about DTEA was to restructure liabilities cheaply. So it comes really down to what can they negotiate with the landlords to bring that down. It's tough to find historical precedents for this, where they actually told you how the leases were restructured. But in general, the landlords will only get what they have in damage from rejecting the leases. And we know that many of the stores are already leased by new occupants. So the damage in that case is very low. We don't know it for every store or for the majority of stores, but it's very reasonable to assume that the leases will be cut pretty substantially. I would think from the original 70 million to maybe 30, 40, 50 million. It's really tough to say. But if you think about that in terms of your EBITDA multiple, that brings in a whole lot of appreciation potential for the equity. So that is currently still ongoing. We know the CCAA was originally scheduled to be finished this December, actually now already. But for some reasons, it was extended. I think it was because they just didn't get the terms with the landlords. And there was also some stuff with the employees, which got some subsidies and they were late and it takes longer. So the new deadline is March, and I'm pretty confident that that will be the final verdict then. So from now to March, we will get to know how much of the leases will still be there to be paid. And the good thing about CCA is there is a monitor, PricewaterhouseCoopers, and they issue a regular report. And in the last report, we can see some very nice new info, namely that all the Canadian stores, the 164 Canadian stores that will be closed, the negotiations there are already complete. And since we didn't hear anything about new financial debt or that they are running low on cash or anything like that already, that suggests to me, it's not clear, but it suggests that they have already cut these liabilities quite a bit in the negotiations. So right now what's only outstanding is basically to get the leases negotiated with the US landlords, and that's just 42 stores. They will be closed permanently. So that is the situation with the restructuring. And in terms of employees, they had about 1,700, and from now on, they only have about 400. So that just tells you how much cost savings there are and there will be. And one final nugget from the PricewaterhouseCoopers report, they talk, when you look at the 10Q, they had cash outflow in the last quarter of about 12 million. Now, in an overlapping period that the monitor mentions, they talk about a cash inflow of 6 million. The 10Q ends in December 1, and the monitor report mentions December 19. Sorry, the 10Q ends in November 1, and the monitor report mentions December 19. That means we already know that November and the beginnings of December were extremely strong in terms of cash flow. That is just another sign that Q4 will be extremely good. I can't emphasize this enough. It will be extremely good, extremely good. And the report also mentions that they had better sales than forecasted, despite making and a strong cash flow, despite making deposits with their suppliers. So this is all really pointing to very good things happening right now. And with that, I just want to repeat again, we are looking at the restructuring of these liabilities. The stock is cheap based on the worst case for all the liabilities are basically going to have to be paid, which I don't expect. I expect them to be cut a huge amount, and we will know probably more than when the next Q comes out, when Q4 is reported, and finally in March when the CCAA is completely closed. Last word about management. We have a transition in management from the old CEO to his daughter. She has organized the whole transition, so it's quite good that she is now taking over, because I can't say too much bad things about the old CEO, but the fact remains that he has run the business into the ground, more or less. So another good sign. And with that, I'm basically finished. Are there any questions?
Great, thank you, Florian. If you have any questions, either put it in the chat room or raise your digital hand, and I'll get started with a question of my own, Florian. You mentioned something, I also saw Mark Gomes mention in the chat room about the lease liabilities are going to be limited because the stores are being released out, so the damages are minimal there. How do we know that? Do we have any evidence that that's happening? Because that surprises me a little bit, you know, with the COVID and the mall closures or store closures. Why are we assuming they're getting leased out? Wouldn't landlords have a hard time leasing these stores out again?
Yeah, we don't assume it. We know it exactly, because there has been a news article that there's a new tea chain just founded a couple months ago or so from an entrepreneurial spirit, I would say. He tries to basically build a new tea business in exactly the same stores. And that news article mentions about 50, if memory serves, of the stores that have been basically occupied already. And we know these are the same stores that these are the stores DAVIDsTea has rejected.
I'm sorry, who was the source for that?
There was a news article. I don't have it right now. It
Okay.
was. I'm 100% sure it was posted in many rooms.
Right. Okay. Yeah. I mean, I'm just a very skeptical person. So I would love to see that article, because it's surprising to me that, landlords are able to release out right now. I hope I'm wrong. So I hope that guy.
I think
wrote the
someone
article
just
right.
threw it up in the chat.
Oh, good.
Ben.
I'll take a look at that later. All right. Let's go to Ashley. He has a question. Did I
Hey,
Yeah, go
yeah.
ahead.
Thanks for the presentation. I think you might have answered my question, but I was kind of curious as to, it would seem once they get leased up that they would probably have to pay the difference in the lease rate.
see.
So I was wondering if we have any way of figuring out what the new lease rate is and whether it's higher or lower than what they were paying. And I would kind of imagine that they might be leasing them at lower rates given kind of what's going on. Maybe the second piece of it is, should we be concerned that they're going to be a competitor?
Regarding your last point, that was my first idea as well, that there is maybe a competitor, and that's bad. But the fact remains that DAVIDsTea is pretty popular. And if you look at the last quarters, I mean, e-commerce sales were just off the charts, up over 180% or so. So they are selling really well, and all signs point to that they are currently also selling really well. They are running low on inventory despite coming into Q4 with higher than normal inventory. And so I think the brand saves us here. We can argue if the tea is good or bad. Some people like it, some people don't, or different flavors, whatever. But the fact remains that currently DAVIDsTea is very popular. Regarding the leases, I don't think we can figure out with any confidence the difference. So in theory, you're right, the landlords will only get the damage. So if they leased whatever for 100 before and now they lease for 90, they get the 10, sort of simply expressed. I don't think it's really possible for us to figure this all out for exactly these stores and to gain any confidence there. I don't think it's possible.
Thank you for that source, Christopher. That explains it. They got lucky. That's a great thing to happen for them over there.
That is very good. I agree.
Yeah. All right, John M. Milanese, I assume. Go ahead.
Yeah, I'm just wondering, you're talking about the leases and the maximum 100 million and maybe closer to 50 is realistic. Is this just the Canadian stores involved in the case, or is this all of them?
So they have now on the books 70 million. When I mentioned 100 million, that would be the enterprise value in that case.
Okay.
It was much more before, but they have already written it down on their balance sheet. So currently the standpoint is 70 million, undiscounted all lease liabilities. So that is really the absolute worst case.
Okay, so that counts or includes all Canadian and US
yes,
leases.
that is all there is.
Okay, gotcha.
That is even including some disputed payables. So not only the direct claims, but also some payables that are in relation to that. Not the normal accounts payable, but sort of all with respect to these leases.
Okay. Okay, thank you.
Okay, any other questions?
Yeah, I got a quick question on this one.
All right, go ahead.
Nice, tough question. So Florian, is this, you say it's a longer term trade for you? How long?
I didn't say it's a longer term trade.
Is
Let
it,
us say that.
will you hold it for years, or is it kind of a month trade for you?
Well, I have been buying when the stock was around 90 cents. I bought more when it was 130, and I will hold until I think it's fairly valued.
Got it. Because I definitely like the stock and the product and the industry and the fact that they're going towards e-commerce.
I mean,
But I
if you think about the long term, I think it's also a reasonable assumption that the business will be sold once they get out of this restructuring. I
Got
mean,
it.
it's entirely possible that the CEO's daughter will want to do this forever, but it's just as likely that there was nobody better to do the job right now, and they are just going to sell to a bigger.
So it's possible another company buys this and adds it to their
Yeah, very
portfolio of
I mean, nobody
many
will buy
goods.
them while they are in CCAA, but after they emerge from that with a clean balance sheet, with all the leases rejected, with good numbers behind them, why not? Could easily happen. I'm not necessarily betting on it, but it could certainly happen.
I guess my only worry is with like the really positive Q4, like you said, and then maybe a great outcome on the lease backs. They have maybe a big jump in share price, but then after that, I'm wondering about their marketing costs. Will their marketing costs increase dramatically because they don't have the mall stores to kind of pull people in? I know they have a strong brand name now, but will they need like higher marketing to carry them into the future?
I mean, it's possible, but I wouldn't say it's probable.
Because I know in the US we have a place called Teavana, and they pull people in, and it's a great experience, and they have great teas, and people buy it as gifts all the time. And that is kind of their marketing, and it builds their brand name over time. But then if you switch to e-commerce, you have that strong brand name, but it could fade over time, and you'll be compared to other e-commerce players. But I think for the short term and even maybe a couple of years, I still see the DAVIDsTea brand being strong enough. So it should do okay. But at some point, they'll have to do some strong marketing to keep up with their higher prices and margins, unless their tea is like exceptional.
Yeah, I think it's important that the brand is already there. And the transition to e-commerce is easy in the sense that the brand is there, the customers know DAVIDsTea, they still keep the people that went into the stores now just order online, right? So there's not much customer acquisition costs there.
Yeah, it's a great product to ship to people, definitely.
And I think if you think about the next catalysts, Q4 should be reported in February or March, I think. So that should be a really big plus for the stock. It also reacted very positively every time the last numbers were reported without any news on the CCAA front. So that is in February or March possibly. It's not entirely clear from the history when they will report. And then in March we will have a plan of arrangement, as it's called. In this plan, the monitor PricewaterhouseCoopers will basically present an outlook for the next 3 years. And that should certainly give us a very good idea how they think the business will perform. And I think that will be the final catalyst that leads to a reevaluation of the company to a sort of fair price, I would say.
Sounds great. Thank you.
So I would not be surprised to see the stock hit 5 or easily much more come that time. The stock is also very volatile. If you think about what it did after hours trading, when the recent numbers came out, it went to 3, then it traded around the next day, and the next after hours trading went to 4. So if you traded that right, the float is not very high, so it could easily just shoot the lights out beyond 5, 6, 7. I'm not predicting it, but certainly could happen. But I think 5 would be a reasonable target to look at.
Sounds good. Thanks for the presentation.
Thank you, Florian. Yeah, that was going to be my last question is valuation, and you just answered it there in terms of your price expectations. So I appreciate that. Ashley had a question about the next earnings date. Yeah, I think their quarter, the reporting period is different, right? It's not ending, is Q4 ending December 31st, Florian?
Yeah, I think so.
Oh, it is.
No,
No,
it's in
no.
January. It's in January.
Yeah, I think that makes more sense.
So
Yeah.
historically, they have reported Q4 in March, in April, and one that was late, I think, in May. So it's tough to really say when that will be. But I'm
Okay.
pretty sure actually that they will have Q4 in the books when the restructuring is announced. Or at the very least, we will know the Q4 numbers when the plan of arrangement comes out. And that will almost certainly be a public document.
Okay, perfect. Thank you so much, Florian. As a reminder, we have the DT research group. I just dropped the link for those even not in it yet into the subscriber room, so we can chat about DAVIDsTea over there. So great. We can have a little bit of an early evening, I think. That was a very productive presentation, efficient presentation, Florian. Appreciate that. So going to trade of the week, it was DAVIDsTea. Ashley, wonderful, beautiful. I love it. 56% gain. I usually actually don't play the trade of the weeks, even though I participate and give my ideas. This was like the first time in months I actually decided to play a trade, let alone someone else's trade. So Ashley, thank you. I bought the stock Monday morning and I did well. That was great. 56% gain on the week. My own pick, Drio, came in at a 4% gain.